Well, good evening. Welcome to session 2 tonight. Glad to see everybody here. I'm trying to move a couple over to panelists here. How about we go around the room and introduce ourselves again on the benefit for our panelists. Again, I'm Sandy Ratliff. I'm with Virginia Community Capital, and but I think all of our competitors ought to introduce themselves and tell our panelists a little bit about what you're doing that can help them out. And then Kathy, you can take over. I'm trying to get everybody over to panelists. So, Kathy, you want to call on everybody?
I can. Okay. So the first person on my screen is Dan Rice.
Dan Rice.
Hey, how's it going, Mickey?
Hey, how you doing, Dan?
Doing good. Hello, everyone. So I'm Dan Rice. What I'm doing is I am opening a fly fishing guide service called River Feet Fly Fishing. I've been in the industry for about 20 years here, and I just moved to Abingdon a little over a year ago from Livingston, Montana, where I ran a similar operation. So what we want to do is we will offer guided fly fishing trips, both like walk and wade, drift boat. Today we just turned in our application to be able to guide on the National Forest lands. We'll be able to do bike and fish trips on the Virginia Creeper Trail. And then we'll also be partnering with like some local area lodges, Airbnbs, that sort of stuff. So we can sort of help package people traveling here, sort of help package their entire trip into one bundle.
Thank you, Dan. Next is Megan Mitchell.
Hi, I'm Megan Mitchell. I'm the owner of Earth and Element, which is a zero-waste, eco-friendly refill store here in Abingdon to reduce single-use plastics in your home.
Very good. Next is Hunter Gregory.
My name is Hunter Gregory. Starting a business called 202 Depot Bike and Shuttle, and we will provide a bike rental and shuttle service to service the salt trail that runs from Glade Spring to Saltville. That's it.
Great. Next is Scott Sosha.
Oh, Lord.
My name is Scott Sosha. I currently own a handyman business called All You Need Is Scott. I pretty much change out light fixtures, toilets, sink fixtures for clients. I'm trying to branch out a little bit more into getting my contractor's license so I can do bigger jobs like bathrooms, maybe a little bit of more remodel work, but that's about it for now.
Thanks, Scott. Josh Ketron.
Hey, everybody. My name is Josh, and I started Ketron Insurance Agency and got a pretty big deal as far as I got a new designation added. I've got today I received my CBIA, which is a builder's specialty designation for contractors, looking to go for my CIC and my certified risk management soon. So cross your fingers, because that's going to be a very arduous task. But we really specialize in contractors, builders, roofers, things like that. But we can guide anybody on things like workers' comp, specialty insurance. We kind of cover the gambit. Personal lines as well. If you hear my dogs, I'm very sorry, but I have a whole rescue in my house right now because my wife loves dogs. And I want to give a huge shout out to Megan, because me and my wife stopped by her store. If you guys haven't had a chance yet, stop by and see her. She's an absolutely awesome person, and her store, it looks really, really good. So I can't say enough about how grateful I am to be here, and I'm excited to learn more about you guys. Thanks.
Thank you, Josh. Jennifer Lowe.
Hi, I'm Jennifer Lowe, and I'm an audiologist, and I'm wanting to start a private practice that's more focused on affordable hearing health care and kind of just pulling in more of those rural patients that really don't always get the education and the top-notch quality healthcare that they deserve. Just kind of wanting to, I guess you could say, bridge some of those gaps in rural healthcare disparities.
Thank you, Jennifer. Kitsy Manuel.
Hey, I'm Kitsy, and I own Love and Light Specialty Boutique. We are an existing business, and we're trying to, expand this year. We've been open in brick and mortar for 2.5 years now. So,
Thank you, Kitsy. And the final contestant on screen tonight is Scott Ramsey.
Hey, thanks, Andy. So, my name's Scott Ramsey. My wife and I own Wendell Gardens, which is we're developing out an agritourism company here just outside of town. We have an aquaponics operation that we just launched our e-commerce store a few weeks ago. So building our subscription list. So leafy greens delivered right to your door, weekly subscriptions. And we are also seeking to open our campground this year by Memorial Day. So it'll be a boutique RV full hookup campground.
Very good. Thank you. And we have Mary Sorensen on. She's not competing, but she's here to learn about the things that we are teaching tonight. And Mary, you want to introduce yourself?
Sure. I'm Mary Sorensen. I am a serial entrepreneur. I've owned an interior design firm for 40 years. I've sold the day-to-day operations and kept the commercial property in Texas. I have a home in Puerto Rico and business there as well. And I'm here in Abingdon to start Revelation Studios, which is a couple doors down from the Barter and across the street from the Martha. And I'm just looking forward to knowing the community better and seeing what I can do to serve.
Thank you, Mary. Okay, so tonight we have three of my favorite people. John Martin is the attorney for Virginia Highlands Small Business Incubator, but he's been my friend for many years, and he is here to answer any of your legal questions if he can. Mickey Tyler with Insurance Center of Abingdon. Mickey has been in the insurance industry for not as long as I've known him, but for a very long time. Since at least the 70s, right, Mickey?
Yes, that's right.
Yeah. Okay. And then Mike Spiegler, who is one of my bosses, but also a friend and confidant. And Mike Spiegler is a CPA with Spiegler Blevins, and he's right across the street from the Virginia Highlands Small Business Incubator. And he's on our board of directors and has been gracious enough to continue to contribute his services. So what I want to do tonight, we usually do this and people, have trouble asking the first question. So what I want to do tonight is ask John, Mickey, and Mike to talk about the differences in an LLC and a sole proprietorship as it relates to the law, to taxes, and to insurance. Take it away. Let's just say John's first on my screen. So, John.
I was going to toss it off to John anyway. I think it needs to start with the legal aspect. You're on mute, John.
Sorry about that. I've been talking away. He was muted. Mike said it'd start with the legal end of it, but I think I always tell my folks that you need to figure out what kind of entity you want to be based on your tax situation. But as Kathy said, my name is John Martin. I'm an attorney in Bristol, but I'm with the law firm of Penn Stuart. We have offices there in Abingdon, and been doing business related law for several years, a lot of workers' comp, a lot of employment law defense, and business organization and business advising when I can. So I think you all are involved in a great program, and I think that I've worked with a couple of folks in the last couple of years who've won the competition, and the ideas are outstanding and amazing, and the energy always seems to just really be very impressive. So hats off, and I hope you continue along those lines. So going back to basic business law, you have all probably run across the term sole proprietorship or partnership, and then you start to talk about the other legal formations that are the legal entities that exist. So the easiest way to kind of consider this is that you really don't have to do much to be a sole proprietor. You can just start work. As long as you pay attention to your revenue and your taxes at the end of the year, you really won't run into too many problems. Now, I say that knowing that you need insurance for so many things in the modern world, but what I'm referring to is the actual inception of a business. If you wake up in the middle of the night with the greatest idea in the world and you decide you want to start trying to make a living doing that, you can get started right then. You don't have to do anything to be a sole proprietor. It's the oldest concept in business. It's just somebody selling their time and skills for money. The law has put certain strictures on that that come along with it. Most notably licensures and tax requirements. As a sole proprietor, unless Mike corrects me, I can go out and practice law and do what I need to do as a sole proprietor and report all of that income under my Social Security number. But be aware that you have to do that. The difference between, and we didn't identify it in the question, but the difference between a sole proprietor and a partnership is that you just add one or two or how many people to the partnership, but you can still function in the same way as long as you've got some ability to control and make decisions. It's always easy to make decisions when you're a sole proprietor, but when you're a partnership, father and son, mother and daughter partnerships, those are kind of common. Folks make those decisions because they get along in their family or they're good friends or that sort of thing. But the problem comes into legal conflict when the partnership, maybe somebody wants to sell their interest in the partnership and somebody else comes along. How do you make decisions? Well, a lot of times you'll do those with partnership agreements, and they're basically contracts on how you operate. So the concept here is you start with the smallest legal existing entity, which is the sole proprietorship, and then you add layers to that. The difference for purposes of legal concern is that an LLC is an entity that exists by virtue of state statute. So you don't have to have a state statute. You don't have to have state anything other than pay particular attention to your taxes to be a sole proprietor. But to be an LLC, you have to go through all of the steps in order to calculate, in order to create the legal entity that allows you to shield yourself. And the idea behind an LLC, or really any business entity, is that you create a type of legal wall between the property that the company owns and the property that you yourself own. So when you add the LLC or even a corporation, you're going to the state, you're saying, I'm going to create this entity, I'm going to operate as this entity, and that is where my liability is going to focus. Whereas if you're a sole proprietor and you get out and you start to do your work as a sole proprietor and you create some liability, you rear end somebody on the way to pick up a load of vegetables, say, then you, as the individual who drove the vehicle, could be potentially liable, along with all of the assets that you've worked so hard all those years to create. That's still potentially possible with an LLC, but the idea with the LLC is that you get to create a layer in between. And if the LLC exhausts its revenue or its resources, it may be difficult to come against the individual who owns the LLC. So I'll stop now, because I think the tax consequences begin to drive your decisions at this point when I talk to clients. And then beyond that, the way you structure your company, the way you structure your operation is going to determine the type of insurance that you need to protect yourself so that you don't run into those liability situations.
Got you. I don't know who you're handing it off to, but I'll dive in here. So I guess the initial question was to talk about the differences between a sole proprietorship and an LLC from a tax standpoint, maybe even an accounting standpoint. And, as John said, the sole proprietorship is the most simple way to organize and operate a business. You don't really have, from a formation standpoint and from any tax standpoint, you don't really have any requirement to have any type of structure around you at all. From a tax standpoint, I'll simply say that there is no difference in taxation between a sole proprietorship and a one-member LLC. In other words, one person is the owner of the LLC. As John further alluded, a one-member LLC reports their tax income and deductions on a Schedule C on their 1040, just as a sole proprietor would. There is no difference in items that are deductible nor items that are taxable to the business as a sole member LLC or an LLC. Once you start moving into more than a partner, then you're looking at a partnership or a multi-member LLC. In other words, more than one member, or maybe even some type of corporation. In my 35 years of doing this, I've seen a lot of LLCs, a lot of partnerships come and go. And I've seen a good number of them just not work out. So a multi-member LLC, a partnership is no different than a marriage, is how I counsel my clients. You need to be ready to be totally honest with your partner, talk about what you don't like, what you like, get along, look after one another. Because, the minute that you start having competing interests or not communicating or just not being on the same team is usually when those partnerships start to unravel and dissolve. For that purpose, you always want to make sure that you work with a good business attorney such as John. This is not a commercial for John, but he truly is a good business attorney because you want somebody who's going to counsel you on how to properly structure that operating agreement that he referred to. That operating agreement is sort of like your, your marriage vows. It sort of sets out how you're going to operate, who's going to be in charge of what, who's going to make tax decisions, who's going to make business decisions, what happens if one of you wants to get out, what happens if you want to bring on a partner, what happens if your partner dies. Do you want to really be partners with his wife or his husband or her husband or however it works? So you really, that operating agreement becomes a very important document and can help keep you out of trouble and gives you something to go to when you're having questions and understanding who is in charge or who is over any particular aspect or how you handle any aspect. For all intensive purposes, for the biggest part, a multi-member LLC does not have any difference in tax items and items that are taxable or deductible than a sole proprietorship or a single member LLC. The deductions are generally the same. There are some different treatments as to how you handle what's called guaranteed payments to partners in an LLC. In other words, an LLC doesn't, owners of an LLC do not take their compensation as we are all used to taking it as a salary or wages and have it reported to us on a W-2. In an LLC, you might take what's called guaranteed payment to partner, which basically is your compensation. There's no tax withholding on it, but it's almost treated like a first level of distribution of profits in the form of compensation. But from a tax standpoint, there's really no difference from between an LLC and a sole proprietorship. They're both reported on the same form. And let me back up. There's no difference in a one member LLC and a sole proprietorship. They're both reported on the same form. They both have the same items of income, the same items of deduction. When you start moving into more than one member is when you start to have just some little differences in treatment. And then, of course, as you move into a corporation, then that's just a whole different ball of wax in regards to taxation, compensation, agreements, and such. So I'll leave it at that point. Any questions on that?
Hey, Mike.
Okay, let's go. But
sorry, Kathy.
Hold your questions, and let's let Mickey tell you about the LLC versus sole proprietorship, and then we'll start with questions. Okay.
Okay. Sorry about that.
Thank you, Kathy. I agree with Mr. Martin. Most of the consideration for your setup should be based on your taxes and accounting. There really isn't a big difference in your insurance exposure or what you're going to have to take care of an LLC or a sole proprietorship. Now, in the area of workers' compensation insurance, again, it's very similar to the way the sole proprietor is treated as far as the way the LLC members are treated. They are not considered to be covered unless they want to elect to be covered. And when you get into corporations and things, you have something different. They're assumed to be covered, the officers of a corporation, unless they exclude coverage. So, but again, I pretty much agree with what Mr. Martin said, that the consideration for your form of business should probably be based on your taxes and accounting preferences.
Okay, so we'll start now with questions, and Dan had the first question.
Sure. Let's see. We'll start with Mike. When you were talking about that payment to partner, is that essentially the same thing, just different language as an owner draw, or is that something entirely different?
Yeah, in a partnership, again, we're talking about more than one partner here, okay? Mm-hmm. And is that what your question refers to, a partnership?
Well, for me, it would be a single member LLC.
Okay. So in a single member LLC, a draw and a guaranteed payment to partner are the same thing. There is no difference because you're really not trying to give any partner a preferential payment that might be in exchange for their services. In other words, if you and I were partners, and let's say I wasn't an active partner, you were working the tours all the time. Well, our agreement might say that, hey, we split profits 50-50, but you get a guaranteed payment of $1,000 a month. So that $1,000 becomes, in effect, the compensation for your services. Or it could just be that our arrangement says that, hey, you're entitled to $12,000 just, for being who you are. It doesn't really have to have any effect. A draw, on the other hand, is technically a draw of profits. In other words, when partners take money out of the partnership, it is, they're taking out their share of profits that hopefully are going to fall to the bottom line. So, and in the case of a guaranteed payment, that payment will be considered a deduction along with other deductions against income to determine profitability. So in that example, if the business took in $100 and paid you $10 and had $30 of other expenses, the profits would be 100 minus 10 minus 30 would be $60 that we would split 30-30, but you also got your $10 of guaranteed payment.
I see. Yeah, cool. Thanks, Mike. I do have one other question for you, and it might be a longer response. If that's the case, I'm happy to just follow up with you later. In this case, so we have some opening expenses that went out in 2022, but we aren't actually starting operation until 2023. In that scenario, do you carry those expenses forward and report on your 2023 taxes, or do you recommend adding those in on your 2022?
Yeah, any expenses related to that are incurred prior to starting business, or what's called a startup expense, and you're supposed to carry those forward and basically start amortizing them over 5 years once you open. I won't say it's 5 years. I hadn't looked at that. 5 years once you open. I think there is a minimal threshold that you can deduct in the first year of $5,000. But you always want to gather those expenses from yourself, all partners, and document them in the form of a list, as well as the supporting invoices and documents, and then get those to your accountant to get on your books.
Cool. Thank you, Mike.
And yeah, there are other costs that go along in that category that are similarly treated. Organizational costs, which are the cost of maybe getting your LLC started up, your attorney costs, your state corporation commission fees, and stuff like that.
You can wrap all those up into the 5-year amortization. Sorry, go ahead.
I don't know. I interrupted you. So your question was, you wrap all those costs up into a 5-year amortization. Is that what you said?
Yes.
Yeah.
Okay. So let me ask everybody on the screen, if you'll just raise your hand. Do any of you have partners? So we're really talking about one person LLCs and sole proprietors, right? Okay. So let's talk a little bit about liability. Mickey and John and Mike, and let's talk to these folks about their liability as far as their product or their service that they're selling.
So I'll kick off. So as I mentioned when I briefly discussed LLC versus partnership, you have to think about liability in two levels, really. One, what kind of liability do you generate as an individual working for the company? And while Kathy just established that everybody is their own company, there are still certain distinctions to be made. And I'll take an attorney, for instance. So if I set up my own practice and I'm a sole practitioner and I decide to create the legal equivalent of an LLC, is a professional corporation or professional limited liability company. If I'm operating it in that sense and I'm giving advice and I create a horrible legal situation that results in malpractice, both the entity, the LLC, is liable because that's where you went for work. That's where you're going to pay your bills. That's how the money is funneled. But that entity is potentially liable. But then I, as an individual attorney trying to practice law, would also be liable because the mistake would likely fall on my shoulders. So in that sense, the liability is blended and it doesn't really distinguish. I would hopefully have legal malpractice insurance that would cover both the entity and myself, because we really are one entity altogether. Compare that with the distinction of somebody coming into my law office and they're in the waiting room and they stand up to walk across the floor and they trip and fall and they break a leg. That liability could be mine as an individual. It's certainly going to be the company because they're still there to secure services and to pay for those services through that LLC. But it might be that it's a cleaning company that didn't put out warning signs, and therefore my practice as an attorney, my legal skill set wasn't online. It wasn't anything that I did that caused the liability, but my company would be liable. And the difference may be that the potential damages are capped or different based on the type of liability. So in some respects, for sole proprietors and sole practitioners, there really isn't a lot of distinction, because if you get hit at that level, you're probably going to feel it fairly quickly in terms of expense to fight insurance deductibles and that sort of thing. But understand that there can be a difference, because in the second scenario, if it turns out to be a horrible accident and the liability extends to the company but not to me individually, then it very likely does not affect the property that I hold, my car, my home, things of value that I've collected. So that's how the liability can be distinguished. And the real trick for all of us practicing in business is to try to make sure that we're covered on all fronts, to cover our company that we own, because ultimately liability against our company cuts into the bottom line that Mr. Spiegler referenced earlier. That's really what we're all talking about. And it also cuts into the possibility that I cannot pay myself at the end of the time period. Whereas if I get hit individually as well, then it could potentially reach out and affect the property that I hold. So that's the kind of scenario that you have to think about in terms of liability. If your company is out in the field guiding, I know we talked about having one company that's a guide. If you're out in the field and you're doing that, you're selling your services as a fly fishing guide. Part of that service includes, a built-in threshold of safety. So if you take someone who's a novice fly fisher into an area where there's extreme risk and danger, you may have a waiver or a liability waiver, but it may be so egregious that your judgment as a professional, so to speak, is called into question and challenged. So you create liability in that way. Whereas if you're, having someone on a piece of property and they're waiting for you to get there and they're, attacked by an animal or something like that may be liability against your company, but it may not be liability against you directly. So you just have to kind of think through those things.
So Mickey, in these scenarios that John's talking about, even though these folks maybe have an LLC and their services are covered by the LLC insurance, do you recommend a personal umbrella to cover any, if I said go down the street and take a left and you get, I'm being very loose in my terms, but and because somebody did something that I told them to do, and that makes me personally liable, what kind of personal insurance would they have if they don't have a professional license?
Well, I recommend all the liability that a person can afford the premium for. I mean, I'm not sure that, there's not a lot of crossover in personal umbrella liability and commercial, but there could be instances where you might be well to have had a personal umbrella. But to piggyback on what Mr. Martin was saying there, commercial general liability usually offers coverage for the slip and fall instances at your business, and usually covers completed operations, like in the case of Mr. Socio, where he's going out and doing work, and his completed work might be, subject to liability if he doesn't do it correctly or whatever. Or in the case of Jennifer Lowe, who's the audiologist, she's probably going to be looking at malpractice or professional liability. And so is the insurance guy there, Josh. So there's really three buckets in the commercial side where you need to think about protection. One is just your premise or your operation, like Dan's up taking people out, as John said, and that's his operation. Somebody like Kitsy, she's going to probably have a shop, so she's going to want her premise to be covered for slip and fall or something that could happen in there. And then the completed ops or products liability, and then the professional liability or the malpractice. So that's something you want to think about if you have those exposures.
I'm going to add one to that, Mickey.
Yes, sir.
In today's environment, if you're keeping any type of customer information, personal information, credit card information, social security numbers, you want to make sure there's liability coverages or pick up any cyber issues that you might run into.
Yeah, I completely agree with you. That's a hot topic. I actually late last year, I attended a seminar about that, and I was astounded at some of the statistics that they gave on the number of people whose information is hijacked and all these crazy ransoms and things. I mean, most of these folks that are here tonight are sort of in the beginning stages of getting their business going, but that's something that they definitely want to think about. And maybe some of their insurance proposals will include that, but it's usually an option. It's not included in general liability or professional or products liability.
Yeah.
But I agree, it's a real hot topic and something that you ought to consider having if you can afford the premium and you have the exposure.
Yeah.
So when you're interviewing or when you're asking for insurance premium, insurance, when you're trying to get an insurance policy,
Yeah.
you should ask about cybersecurity in that policy, right? Is that what you're
Cyber
saying?
liability. Yeah, cyber liability is actually what it's referred to. Yeah.
Yeah. And I would just follow along with what the other two folks have just said, because I know from our own perspective, our firm has started to do an insurance. We started it several years ago, but basically we sit down and we take things like Mickey just mentioned. You know, somebody has gone to a conference and these are new issues. So we sort of do our own insurance audit to determine whether or not we need to talk to our providers to see if we need to add this insurance or that insurance. And the list, it's forever growing. But bear in mind that when you talk about what liability is breached when somebody fails to provide a duty of care. And a duty of care is based on what you know, what the industry knows, all of those things that a reasonable person in your position has come to acquire as knowledge in their skill set. And then what other like-minded folks in the same industry do. So, you know, when you talk about cyber insurance or cyber liability, you know, the reality of it is all of us work with some sort of electronic device. And so, you know, the days of saying, well, I didn't know you could get hacked, those are gone. That's not going to be, you know, as someone who takes in that information and stores it in some sort of electronic device, the courts and the general community are going to expect us to have a duty of care to protect that information. So, you know, that standard is ever evolving and ever changing. And so part of what you do in your business is to know what other people do in their work. So I'm always a big proponent of keeping up with conventions, keeping up with trade alliances. You know, you get those newsletters, and rather than delete them, you know, take a quick read because the headlines are very important.
So Scott has his hand up if you would like to ask the next question, Scott.
Yeah, thank you, Cassie.
Then Jennifer.
Yeah, John, question on the cybersecurity liability. If I'm using a service, a third-party service like MailChimp, or any type of other like customer relationship management software like HubSpot, would the liability then fall on them since they're the data processor storing the customer's data?
Yeah. So the the term joint and several liability is the one you want to look out for. And what that means is you're engaging the customer in convincing them to surrender that information, and you're reaching out to a third party to hold that information for you. Well, you're jointly and severally liable with everybody who's engaged in that process. So what you want to look at, and I'd almost tell you, you want to look at your purchase agreement or your service agreement with them. And I'm going to bet that somewhere down the line, you'll see some language in that agreement that talks about indemnification. And what that means is if they'll say to you, because they're the 800-pound gorilla and you're the small fry, but that agreement is going to say to you, if you do something that causes a breach of our system, then you're going to indemnify us from the point of the cost and expenses that you created. That's the legal contract. So while liability may be equal across the board, they're going to come to you. It's very unlikely that if you're purchasing that as a consumer, that you're going to see an agreement that gives you that kind of benefit. So you need to look out for that. You need to be aware that they may have in their agreement that they'll cover a breach up to the first $25,000 worth of damage, and damage being, you're to run some sort of credit check on your clients to make sure that none of those Social Security numbers got out there and are used by other companies, or they've been attempted to be used in some sort of fraudulent activity. So the agreement is going to tell you what you should expect in terms of a breach of that liability.
Jennifer?
My question was very similar. I just had to do like some demos with electronic health records, and our insurance also has to, of course, cover like HIPAA. And so it's the same kind of thing. I was wondering, because this one that I demoed with yesterday is completely cloud-based. So you can access it from anywhere, but you have all of this, patient information, but it's on the cloud and it's just server-based. Like you don't have anything downloaded to the computer. And like if that was ever breached in any way, I was going to ask the same exact question that Scott did. Would I be liable for that? Seeing that like I'm not storing anything, it would have to be, hacked from, their service. So I didn't know.
So what you have to think about in terms of say I'm your patient, Jennifer, and I have a situation where I suspect that my information has leaked by virtue of the fact that I went to you, whatever that may be. If that turns into a situation where I'm basically damaged, somebody goes out and they, do some sort of transaction using my identity, and they cost me a lot of money that I have to try and repair. If I go to an attorney to try to help me recover, the first thing they're going to do is they're going to send a claim letter, and they're going to name you and the cybersecurity company. And then that's going to put you in the cybersecurity company, the cloud-based server company. And that's going to put you two pointing fingers at each other. So, that's just always the way the litigation goes because of this term joint and several liability. So in that sense, if it comes to a lawsuit, then I'm going to sue both of you and let you two point the finger at each other and show me why I'm wrong as to naming you or why I'm wrong as to naming the cloud-based server. So, and unless you have a really good, large companies are going to have indemnification agreements in their contracts with their server providers that likely none of us here are going to be able to leverage in terms of our income or that sort of thing. We're consumers at that point. We're not contracting agents really. But one of the things to remember, and it's an ever evolving process. You go online to use those cloud-based services, and you'll see that disclaimer button that we all click and breeze right through. The law is changing as to whether or not that constitutes one, a binding contract, and two, whether or not that a change in the disclaimer language. And if you've ever sat down and read one of those, it's painful. It's painful from someone who does this with some regularity. But the law and the cases have been decided. They usually say that if the server or the cloud-based company or the whatever company you're using makes a unilateral change to this agreement and you know nothing about it and don't have a chance to meaningfully agree to the change, then it doesn't bother you. But I've had a client that stored their health information on a cloud-based server, and in order to actually get to those patient records, they had to click the disclaimer saying, we basically accept the terms and principles of the end user agreement, including any changes that are recent. And one of the changes that this company was fond of doing was changing your fee. So, those agreements, as annoying as they are beginning to carry more and more, weight and legal significance. So they'll tell you what your indemnification aspects are, just as we were talking about with Mike.
Yeah, without diving in too deep, I'll just add that these cyber policies will provide coverage for you for your losses, but only to the extent that you follow whatever they dictate as their security protocols.
Absolutely.
So, to go out and buy a policy and not really find out what the protocols they're calling for and follow them and get with your IT people to make sure that you meet those protocols. You may be throwing good money at bad money.
Yeah.
And there are differences in policies. Some provide coverage, cover expenses, and some actually provide full breach responses.
Yeah.
So
Excellent point.
just, without diving in too far, just make sure that you cross your T's and dot your I's with your coverage. And it's a real issue for all of you because I'd say you all take credit cards. You all have this financial information on hand somehow, somewhere. Looks like Kathy must have went swimming because she's.
I was going to say.
Hey, does anybody else have any other questions? Come on, contestants. There's got to be more that you want to learn about.
I do have a question for Mike, just to revisit an earlier topic. When you mentioned there's really no difference between a sole proprietor and a single person LLC with respect to tax filings. I presume that's the same if you're married filing jointly.
Yeah, I mean, because that reporting will just go on Schedule C on your joint return. Now, there could be differences in the tax calculations of married filing jointly versus married filing separately. That's a whole separate issue and calculation. But yeah, it all goes. That Schedule C is just part of your separate or jointly filed return.
Understand. Thank you.
So, back to taxes for a minute, Mike. In an LLC and in a sole proprietorship, what's your advice on Social Security taxes?
Well, in both instances, if we're talking about active businesses, which I think everybody on this production is an active business. In other words, we're not talking about a passive rental type of activity. So in both the sole proprietor or the single member LLC, all of the taxable income is exposed to self-employment tax, which is the replacement, I guess, for sole proprietors for Social Security and Medicare that we all see on our paychecks, whether you know it or not. When we all have at some point in time worked for somebody else and been paid on a W-2, if we looked at our pay stubs, we would see federal income tax withheld, Virginia income tax withheld, and we might see Social Security, Medicare taxes withheld. Well, those Social Security and Medicare taxes, which total 7.65% of your taxable pay that come out of your pay, are also matched by your employer. So he withholds 7.65% from you and paid a 7.65% from his funds to the Social Security Administration. Those 7.65% times 2 is 15.3%. In a sole proprietor or single member LLC, your profits are exposed to a 15.3% self-employment tax. So you end up paying the same Social Security taxes that you would have if you were employing yourself, so to speak.
And to follow up with that, tell everybody when they think that they buy something that costs a lot of money, that it's an expense. Tell them about something that costs, I don't know, $10,000. Let's say a piece of equipment that costs $10,000.
Tell them about a piece of equipment. Okay. So I think what you're referring to is the fact that, you tell me if I'm wrong here, if I'm going down the wrong path, but basically, if you think about it, if you just earned $100 of income and had no expenses, and you file, well, let's a bigger amount, let's say $10,000, $100,000 of income, and you put that income on your return, you'd end up paying some income tax based upon your marital status, your tax, and your other sources of income, and it might fall anywhere, in a federal tax bracket, let's say between 10 and 37%. Well, if you got to the end of the year and you had that $100,000 and you said, well, I need a piece of equipment, I wonder what the tax ramifications are. Well, that equipment, in most cases under current tax law, is going to provide you some type of deduction, whether it's depreciation over a period of years or a first year write-off of 100% of the cost. But so all of a sudden, if you go out and buy a $40,000 piece of equipment and you're in a 37% bracket, well, all of a sudden, your tax bill is going to go down by 37% of $40,000, or let's just call it $16,000. So is that what you're referring to, Kathy? Is the tax savings generated by buying equipment or paying incremental expenses?
For things like that, they're not 100% deductible the first year. There's a cap on that, right?
Yeah. So, under current law, there are a couple different ways to treat, and we'll just call it furniture, fixtures, and equipment. There are some regulations out there that we use to determine what can be written off as an expense and what must be capitalized as an asset and depreciated over a period of time. But generally speaking, anything over $2,500 of cost can be written off as an expense. But once you purchase a piece of equipment and it's determined that it has to be capitalized, well, then you have some options. You can depreciate it over the useful life of the equipment, which the IRS dictates based on the nature of the equipment itself, and that could be anywhere from 5 to 39 years. Most equipment is 5 or 7 years. Or you can use one or two tax conventions to write it off 100% the year that you acquire it. Each of those tax conventions have different ramifications. One really looks at your profits to see if you have room to write it off, and you can only write it off under that section to the extent that you have profits. And the other one allows you to write it off 100% regardless of profits, but all states do not necessarily follow that method of depreciation, so it might cause a state add back. But generally, when you buy a piece of equipment, you're looking at writing it off over a period of time or in the first year. And here for the last few years, we've had a lot of different options and use fixed asset acquisitions and really do depreciation planning to help clients maximize their deductions.
Okay, guys, this is your chance to ask questions from folks that have been in the business for a lot of years. So do you have more questions?
I was wondering if one of them could explain with tax deductions mileage, because I've heard if I drive to a RAM clinic, like a remote area medical clinic, and do volunteer for the weekend, is that something that, can you do daily? How does that work in terms of mileage when you own your own business?
So, vehicle deductions in general are very susceptible to abuse. I'll just leave it at that. In other words, everybody wants to think if they go out and put a poster on their car that has their business name on it, that all of a sudden that's a business vehicle and they can write off 100% of the cost associated with that vehicle. from the tax standpoint, the Internal Revenue Service looks at vehicles as what they call listed property. They understand and realize the potential for abuse. So they have some regulations that basically say, and I'm just going to boil it down to real simple here, that basically say, you can take deductions for your use of vehicle based upon the percentage of business use to total use. So in other words, if you've got a vehicle that you're driving 20,000 miles a year and you put 2,000 miles of business use on it, well, that's only 10%. So you might only be able to write off 10% of it. Your other option is to keep track of your quote unquote business mileage, which I'm going to explain basically what it is here in a second, and just take a deduction based on what they call the standard mileage rate for your business miles. So, for 2023, I think the business mileage rate went up to 65.5 cents a mile. So under that scenario, if you drove 2,000 miles, you get about a $1,300 deduction, I think is the math, for that business use of that vehicle. And that mileage rate is supposed to take into account the cost of fuel, as well as the operating cost and depreciation of the vehicle. So, what is business use of a vehicle? Well, business use is again, I'm just going to boil it down real simply. When you drive back and forth to work, that is not business use. That is commuting. So the IRS doesn't allow you to take a business deduction for commuting. But once you get to your office, or even if you leave your house and go directly to a customer's place of business, that is business use of a vehicle. Once you get to the office, generally anything that you do, any place that you go for business purposes is business use. So if you go to the post office, if you go to the bank, if you go to a client's office, if you leave your house and drive to Minnesota for continuing education, that is business use of a car. So, what the service wants you to do, according to regulations, is keep contemporaneous records, which basically means keep a log of all your business miles, where you went, what your business purpose was, and keep track of your total mileage for that, from that standpoint also. So, that the business mileage is what determines, first of all, how much business deduction that you might have available to you under either the standard mileage rate or a depreciation method on your business vehicle.
And John, Mickey, just a question on that behalf. What I was something that happened to a company-owned car for Virginia Community Capital is one of the employees was out in town here in Abingdon, and a delivery person for Papa John's hit them head on and did a lot of damage to our vehicle. And that person was doing deliveries on behalf of Papa John's. And I think the way it happened is that their insurance through Papa John's had to pay us to get our car fixed. And correct me if that's not the correct way it happens. If an employee is doing deliveries on your behalf as the company owner, who's at fault, or who has to pay for that?
Well, it can be either, but it's usually falls to the company.
There was somebody that we've got some hands up, but I want to follow up on that liability for just a second. Jennifer said something about volunteering for RAM, and that brought a liability question to me. So you have an organization that's a 501c3 and you volunteer for them in your business capacity. Tell me about that liability. let's say you do something wrong, or I don't know, you cause somebody to trip and fall. Who are we talking to? What are we, what's the deal now?
Well, if you have insurance coverage, you have coverage, or you have defense costs if the insurance company doesn't think you were negligent or should be liable.
501c3 would be the first insurance company, or it would be your insurance?
Your insurance company. Her insurance company. I'm not sure who'd be first, but she would have coverage protection under her policy, or defense costs if her policy says that she wasn't negligent and they're not going to pay for the damages or whatever.
Yeah. And in addition to that, in terms of Jennifer providing a medical service, her insurance, you need to make sure, but typically those kinds of events are covered as part of your malpractice coverage.
Yeah.
So in the event, to extend your scenario, if she went there and did something that caused harm to one of the patients, typically her insurance would cover, but you need to make sure that activity is understood to be part of what you do in your practice, that you consider volunteering to be part of your overall community service, community work and practice. Typically, a lot of times those activities are almost considered marketing, but we do pro bono work, and most professional boards want you to do some sort of pro bono work. So as a public policy, those things are picked up and covered. And going back to Sandy's question, she brought up an interesting point. So that individual is driving for her company, and they're struck by Papa John's. Their vehicle is damaged by Papa John's. Her company would own the vehicle that was damaged, so they would own the right to sue to recover for the damages to the vehicle. But if you take that and extend it and say the employee who is working for Sandy's company, Community Capital, is injured in that event, and they're doing work for the company, they're going to attend an appointment, or they're delivering packages as part of, whatever that may be, that individual working for the company, they're doing everybody's heard the term, agency. They're an agent for the company. So just like if you hired somebody to help you part-time in your own business, they're an agent of your company. So if they're doing the bidding of your work, assuming you meet the threshold for workers' comp, that's a compensable injury that comes into account. And then that claim against the Papa John's driver becomes basically part of the recovery under workers' comp. It's a subrogation issue. So all of these things have spider web connections, but you start at the basic and then you work your way down.
Okay, so thank you. Hunter, we've got two. Dan took his hand down, so we got Hunter, and we'll let you ask the next question.
My question is about hiring employees as far as taxes, W-2 versus 1099 and workers' comp, that sort of thing. I just wanted to know a little bit more about that.
Take workman's comp away, Mickey.
Well, employee and 1099 don't go together. So if they're employees, you got to treat them like employees and pay them. I'll let Mike talk about the way you pay them or whatever, but what was it Mike said a little while ago about some of the things that the IRS looks at or whatever? The insurance companies look at people who use 1099s. They don't look real favorably on those kinds of businesses and operations, because you they still find out that people are being treated like employees. So therefore, when the person gets hurt, then they expect to have workers' compensation coverage. And if you've been treating them as a subcontractor, but if you've been paying them like a subcontractor rather and treating them like an employee, many times the workers' comp insurance carrier has to pick up the coverage that they weren't getting any premium for. So that's the side of it on the insurance that I would just caution you about. If they're employees, treat them like employees, pay them like employees, and cover them like employees. If they're truly not employees, they're subcontractors. Like, for example, I am a subcontractor. They cannot tell me when to work, and not necessarily tell me even what to do when I work. They can provide me certain things, but there's a lot of loose ends on the freedom that I have as a subcontractor. Now, I try to be diligent, and I try to do a good job for the people that I contract with. But in my case, it works out for me. But you just want to be careful when you're hiring people, and I would caution you about using 1099s.
Yeah, let me slide in right behind Mickey just before Mike gets to the tax consequences. I do a lot of workers' compensation litigation, and Mickey is completely right. What you think and how your employee thinks and how everybody operates may not be what the courts think at all. Yeah. You may even have written agreements that say, I, John Martin, understand that if I work for Hunter, I'm a subcontractor or I'm a contractor. And all that may be fine, but this is really a situation where the courts look at it and they try to determine if it, walks like a duck and quacks like a duck, then it's a duck. And it doesn't matter what you called it, it's still a duck. And they're going to apply the appropriate law to whatever that may be. So there are a lot of things, but basically control is control of the day. Just like Mickey said, the control over what that person does and how they do it. That's a huge part of the test. And the test is very, very long, as I'm sure Mike will get into, because it's borrowed heavily from what the IRS determines to be a contractor versus an employee.
Right. And as I've been infamous for so far, I'll try to keep it simple. But the IRS, I want to say they have about 20 different questions that they use to help you determine whether or not you have an employee or an independent contractor. And as Mickey alluded, they're opposite facing positions. That you can't be both. And really, the differentiator boils down to control. How much control you have over this person who you're trying to determine the proper treatment of. If you have them fill out employment forms, if they have a continuing relationship with you and only you, if you're providing their tools or their equipment or the materials, if they can quit working for you at any time and not have to complete their job, if they have to, come to work when you tell them to work and work where you want them to work and do the work in a manner that you want them to do it. And if you have to give them training, they're probably your employee because, they don't have it. There's no independence to them. They can't, they can't work for you and somebody else and say, oh, well, I'm going to work for John today and I'll be back Thursday. And, they don't have their own tools. And so, it all boils down to control. And, everybody would love to treat the people that work for them as independent contractors because it's a lot easier. You get their social security number and maybe you don't even do it, but you send them a 1099 at the end of the year. When they're your employee, all of a sudden you have to make sure you have an employer identification number. You have to register with state taxing authorities, and you have to calculate payroll. And what that means is that you have to withhold those taxes I referred to earlier. You've got to pay them. You've got to, you've got to do all the things that you're required to do from a legal and standpoint to, to protect your employees, to provide employee benefits, perhaps. But, a lot of hoops to jump through once you start having an employee. It's probably the biggest headache to small business owners is dealing with employee payroll and employee issues. But at the end of the day, that's what most of us want. We want those people that we can control, that we can teach our methods and our practices, that we can impress upon them customer service capabilities. But yeah, it's not optional. You basically, you have to make the determination of based on the regulations of how much control you have over them, and once you figure it out, or once somebody helps you figure it out, then you just treat them appropriately.
So one last question, then I'm gonna let Scott ask his question. So at one time, and I know laws change, the word regular employee, that there was a workman's comp rule that said you had to have 2 or 3 regular employees. Is that still
that's the terminology they use? Yeah, because people will tell you, well, that person's not part-time, I'm not going to count them. Well, the part-time doesn't apply. The Workers' Comp Commission uses the term regular. So if they work for you regularly, and the rule in Virginia is 3 regular employees brings you under the statutory requirement for workers' comp.
Okay. Yeah. Thank you. Okay, Scott, it's your turn.
Scott, I'm
muted.
Scott, you're muted.
I sure am. Sorry. Thank you, Kathy.
We thought maybe you'd gone for a swim.
Yeah, I went over to Kathy's box here.
Yeah.
So actually I have 2 questions. They're both tax deduction related. The first question, we are in the process of transferring one of our personal vehicles to the company to be listed as an asset. What is the best way to take the deduction on that? Is that mileage based, or is it depreciation and fuel?
It all depends, and it all depends upon the items that I referred to earlier. What is your total use of the vehicle? What is the business use in terms of mile? Both of those are in terms of miles and percentages of total miles. And then you have to look at the type of vehicle is to see, what type of class it falls under. Is it, a luxury car, which I think nowadays is defined as anything under $23,000. Is it a pickup truck? Is it a dump truck? Is it a trash truck? All these they have different classes for different types of vehicles because they're all susceptible to different levels, or maybe not susceptible to personal use. And each class has a different depreciable life. There's no right answer. It's an analysis that has to be made based upon the fact pattern and the cost. And it's not a year-to-year decision. Once you make the decision to capitalize and depreciate a vehicle, well, then you can't switch for that vehicle. You can go from the cents per mile method. You can't go from the cents per mile method to depreciating it in later time either. So you have to make that determination based upon the facts and circumstances of not only in the year that you place it in service, but you have to sort of think about, well, how long you're going to have that car, what's going to be your fact pattern going forward.
Mike, if a company uses a vehicle for both personal and company use, aren't they supposed to log the mileage for each? And like, if you have one car that you use both in your business and at night to go to wherever, are you supposed to, how do you do that if you depreciate the vehicle instead of claiming mileage?
Well, yeah, I referred to that earlier. If you capitalize and depreciate your vehicle, or even write it off in the first year, you are required to keep track of your total business miles as well as your business miles. Because
you mean personal
percentage of business use. Well, if you have total and you have business, then the difference is personal. I'm sorry. But yeah, so you're required to keep a log of that business use, which includes your business purpose, why you used the vehicle for whatever that daily trip was, or that one trip, where you went, and who, and if you saw somebody, who it was. Those requirements. The reality of them is it takes a lot of effort to keep track of that. And there are apps out there that'll help you do it. But the reality is that most people do not do it. And at the end of the year, they're gonna come up and try to guess their business percentage, or they're gonna go back and refer to their calendar to try to figure out where they went. But just know, if the service ever comes in and decides that they want to look at your automobile records, and the fact that you have a business vehicle is cleanly depicted on your tax return on a separate schedule, so they'll know. And if they see a business that that seems to have an inordinate amount of business use, then that information is right in front of them to ask the question. So you always want to keep the records.
Okay, Scott, you had another question?
I did, thank you. So my second question is, we grew an abundance of produce over the winter, and we donated a lot of it. So the question is around charitable deductions, and how do I account for that in my bookkeeping? Is it the retail value of what was donated?
That's a good question. For tangible property, you get 50% of the difference between your cost and your fair market value. For raised produce, I don't know if it would be the same or not. I imagine it would be, but you might have me on this one. I've never looked at that. I presume that your products would be considered tangible property and don't fall under some type of special agricultural provision. But generally, if you had an inventory of widgets that cost you $20 and you sold them and the fair market value was $100, then you would get 50% of the difference as your write-off. But I'll just have to check on it. I appreciate that question.
Oh, thank you, Mike.
I'll have to get your email address.
So for the service businesses, if no money is exchanged, is the service tax deductible?
If you're asking me, the answer is no. The IRS does not allow you to deduct blood, sweat, or tears.
It's good.
Yeah. Okay, so Kitsy, do you have any questions about retail? John, Mike, or Mickey?
I could throw one more out, Kathy, if we had a minute.
Please do.
It's sort of a legal question, John. Might take me a second here to kind of build it into a question, but in the previous state, I had an LLC and then 3 DBAs that worked under that. So I'm curious about, I guess it's a DBA related question. So and that was easier, right? Because then you could have just one EIN and one bank account. It simplified a lot of things. So that's sort of the vision I took starting here in Virginia with, built an LLC with the idea that it's a different name than what my DBA for the fly fishing company will be. So I guess my question is, do you see any pros and cons to operating a DBA underneath an LLC versus just having that as the name of the LLC and operating? So I guess declutter the mystery here. So the LLC is called River Feet Ranch, and the DBA will be River Feet Fly Fishing. And then I have another business that will be coming in underneath that as well. So I guess, are there pros and cons to having it set up like that, where there's DBAs operating under an LLC versus just having those DBAs sort of have a River Feet Fly Fishing LLC versus operating that under the River Feet Ranch LLC? Does that question make sense?
Yeah, it does.
Convoluted.
Yeah. Making sure I'm not muted. Yeah, it does. In my experience with DBAs is that they're used for one of two purposes. One, they tend to segment the operation so that you kind of have a flow, and it's sort of it helps you track what you're doing in terms of that particular entity, that sub entity. And the other thing is that a lot of folks use names associated with, a DBA, doing business as a branding technique, or as a branding marketing scheme, so to speak. The thing to remember when you're operating your company as a DBA or doing business as, you still have to register that with the Virginia State Corporation Commission.
Mm-hmm.
And in terms of liability and that sort of thing, there really isn't any kind of legal distinction. So a doing business as is a pure legal fiction. Now, that said, you may decide that you want to do hiking tours in addition to fly fishing tours. And so you may want to name one part something else that's similar, but you, as you pointed out, you don't want to bring in another EIN. You don't want a different set of tax papers and different bank accounts and that sort of thing. So a DBA can be very beneficial in that capacity, as long as you remember you have to file. And I meant to get to this in the beginning when the questions heated up, but when you form an LLC in Virginia, you have to file the articles of organization, and those are the paperwork. Those are the papers that give you life, and that is the thing that allows the state corporation commission to acknowledge that you exist. You have to refile every year, and you have to pay your fees to keep that legal. If you let that lapse, that fictitious line between you and your LLC will fall. The general rule is that if a LLC lapses, then the individual who owns it is considered completely liable no matter what. So you file the operating agreement that Mr. Spiegler talked about earlier, which tells you how to operate. If you create a DBA underneath all of that, the DBA is going to be owned just by necessity of the way you file it with the State Corporation Commission. And the reason you file these documents is so that in the event of a lawsuit, it's easy for somebody to look it up and say, hey, that's the company that I was with when I got hurt while fly fishing. I need to know who to send the paperwork for the lawsuit to. And that's why you also have to register a DBA. The last thing I would say with that is, if you have a DBA that's really trendy, really cool, has a lot of goodwill to it, that can be registered as as property. You can trademark that sort of thing. You can, make that part of your overall operation. So that's just the way to keep in mind. It really doesn't allow you to create a second company or anything like that, because in the end, it all funnels back down into your LLC. But it does give you that flexibility that I think you were talking about with your previous enterprise in your other state. Does that help?
Yeah, perfect, John. Thank you.
Okay.
John, let me ask you a question. One thing you didn't realize, who was that? Was that Dan's question?
Yes.
So what thing John, take that question one step further, because, Dan has a really nice lodge in his DBA, but he also, one of his fishing expeditions, they dynamite fish. And he might have some exposure to some excessive liability. Would you recommend that those two different DBAs be under the same LLC?
Well, yeah, that's perfect, Mike. I mean, I think that's the kind of thing you have to look at when you start to consider what you're mixing. I mean, if you do mix something that that causes extreme exposure, and it's a DBA, that it's the same as, I don't want to get too simplified, but if it's, just an ice cream stand and a hiking company, and you take someone out hiking, and they get injured, then that ice cream stand is on the hook too. So those are the points. A lot of times people will take a look at those things, and they'll look at it's the old risk benefit analysis. Do I want to keep these things different? Do I want to spin this off? That's the kind of thing that you have to look at and weigh as you grow. It may be cheaper and easier to do the separation, but as Mike said, when you start to mix apples and oranges, you may not always get the fruit salad you're looking for. It could be really dangerous, and one could overtake the other.
Thanks, John. That's so wild. You said ice cream and hiking, because those were two of my three businesses: an ice cream shop and a guided hiking tour shop as well. So wild, and
a lot of that makes perfect sense. I mean, you're trying to generate that sort of built-in consumer group, but Mike brings out the perfect consideration as you go along. Is it worth one to combine the two? Do you take folks out and experience twisted ankles all the time? Is it just a matter of time before you look at somebody making a claim for medical, or even worse, liability? Whereas, and I'll defer to Mickey, because in all the years I've done workers' comp, this has always eluded me. But when you have employees and they're doing certain things for you, those employees are coded under the insurance industry codes, and each code is presumed to be a little more, it generates its own level of risk. So, for instance, the one that we always talk about is being coded as a roofer. The end result is it costs you more in premiums. So just what you're talking about, somebody operating in an ice cream store, they're probably not going to cost you a lot of overhead in terms of expense and things like that. Whereas somebody who might work for you as a hiking guide is very likely to fall down the hill and break their leg if they go out twice a day, every day through the summer. And so those people are going to be coded differently. And that's the same thing that Mike alluded to when you talk about mixing and matching your risks. At some point you may want to say, I need this to be completely separate as a completely separate LLC for my own protection, to increase my protection.
Think of it in terms of, do I want to expose my assets from one business to the liabilities of another business?
Yeah, absolutely.
Sure.
Very valuable piece of knowledge.
Let me interject something on that. Some insurance companies will let you commingle those on the same policy, though, and will set up separate classification codes, to represent the exposure.
Sure.
So you could still combine the insurance coverage. Might not be as, it might be a little more expensive, but it wouldn't be as expensive as having two policies.
And Mickey, correct me if I'm wrong, but if you're buying workers' compensation insurance, you'll want to check that annually to make sure that you're still in compliance with the policy that your provider sells. Is that right?
Well, normally the companies do that. I mean, internally, they through a process of auditing, they don't only pick up their exposure and the amount of payroll, they pick up the class codes as well. Is that what you're referring to?
Yeah, I know I've litigated cases where the general defense is, I know we had a famous case where the person classified his employees as cleaning people, but what he didn't let the insurance company know is that he was cleaning construction sites. And it's totally different risks, totally different exposure, and it nullified the contract. So in the end, the insurance company said, that's not what we signed on for. You don't have coverage with us.
Right. That didn't happen at the point of a claim, though, did it?
Yeah. Well, yeah. Yes, it did, actually. It did happen at the point of the claim, but there were allegations of fraud on the part of the company that purchased the insurance.
Yeah. Well, I had one time where a guy was farming, but he was also logging. And he classed everybody as farming. Yeah. And then we had a guy get hurt real seriously in a logging accident. And the company ended up having to pay it because it's not far-fetched to imagine that a farmer wouldn't cut some logs occasionally, but anyway, I felt like I was taken advantage of on that one. But it's been several years ago.
So I don't know why this is, but when the Workman's Compensation sends us a questionnaire that asks how much each employee made gross wages, and they will ask how much the folks that you wrote a 1099 for, how much your 1099s were for in Workman's Comp. So do they kind of cover them too?
Well, they could be brought into a case of coverage. And some of the companies, well, this is more in general liability. They'll actually make a charge for your subcontract payroll. But now, I'm not sure they do that in workers' comp too. I'm sorry, in some classifications. Yeah. Yeah.
Okay. Yeah. And so go ahead.
Well, I was just going to say one I messed up on with you guys is I was trying to get your officers who serve at no remuneration. I was trying to get them excluded from coverage, and they don't need to be excluded because they don't get any remuneration. So, yeah. Anyway, go ahead.
Kathy,
go ahead.
Kathy, I was just going to say, I would go back to your question about why you're asking about your 1099 employees as well. One of the reasons that I'm familiar with is they ask you to see if it's excessive. So, if it looks like you're, front loading everything as 1099 employees, then they may go into a deeper audit to see so that they don't get a surprise down the road when it turns out that the Workers' Comp Commission says, no, that's not an independent contractor.
Yeah. Okay. They may actually do an inspection or, use one of these, private investigator type thing to inspect and see what's going on.
Okay. So Dan, there's a couple of brief things. I was surprised. I was trying to help somebody sign up as a small women and minority owned business. And on the State Corporation Commission website, you have to now apply for a fictitious name certificate. So if you're Dan Rice, sole proprietor, doing business as, North Fork River Rafting, you have to apply for a fictitious name certificate to get that name put on a bank account, for one thing. The banks now will not let you put a fictitious name on a bank account without having that certificate from the State Corporation Commission, which is new from when I was a sole proprietor. So that's one thing that you have to look at.
Is that for sole proprietor only? Because didn't have to do that when registering as an LLC. Didn't have to be a fictitious.
It's for sole proprietor only. It's if Kathy Lowe is doing business as the male ego, and I had to apply for a fictitious name certificate to get the male ego put on those checks for my own bookkeeping purposes, so that I knew, I put everything in that account. So
that's one thing. Sort of a fishy sounding name. That's probably the reason. I'm sorry. It's getting close to my bedtime. I'm going to
get punchy.
I'd probably get a background check. Might be my guess.
That's right.
I thought you were asleep, Tanya.
I'm being very quiet, Mickey. Thank you.
Well, thank you for being very quiet.
So the last question, or not question, but comment that probably all three of you have an answer to, is that everybody that is participating tonight has some sort of liability to the public. Do you all recommend a contract for your services that you have folks sign before you perform those services?
We do. It's called an engagement letter.
I know.
And it clearly outlines the expectations that you should have for our work, and that we have the requirements we have to achieve your work. It also talks about billing structures, fees, collections, and it has. I'm just going to say all the legalities that Mr. Martin probably knows more about than I do, as far as how to handle disputes and repercussions from doing below standard work. And I just use that term because it applies across more than my business line. But yeah, so it helps having contracts or engagement letters helps hopefully take care of issues before they become legal issues.
Yeah, we do the same, and I'm betting that they look very similar because the same concerns are out there. But with larger, I do a lot of work for insurance companies, and they will issue a contract, and if we want their work, we sign their contract. So, but in terms of smaller, more intimate clients, we definitely do the engagement letter, just like Mike.
Okay, so I've asked all the questions I can think of that I've heard people ask us. Do you all have any more questions? This is your final time to actually ask a professional instead of getting opinions of some of us who think we know the answer, but maybe don't.
We got some hands raised.
Question. Oh, I'm sorry.
Go ahead.
I just had a question about volunteers. Oh, now my dog's going to start barking. I'm sorry. So like when I get I just realized I have to have like 10 different types of insurance, by the way, but when I get my malpractice insurance and liability insurance for my practice, sometimes we have volunteers, either medical school students or doctoral students, or just volunteers in general. We're going to, especially at the beginning, we're going to have a part-time volunteer that's just kind of helping get things set up. Are they covered, or do they, I know like probably for medical school, they probably have their student malpractice insurance, but is that going to apply, like in our practice in terms of liability, or do I need to tell the one providing the insurance to us, hey, sometimes we have volunteers? Like how does that work? And maybe some other people here are going to have volunteers that are going to be helping out occasionally too. So that might help them as well.
Yeah, I think, the thing you have to remember is that you have to consider what your exposure is. As Mickey mentioned earlier, if you're not being paid, then there isn't a workers' compensation component for indemnity, but there might be for medical. But if they're a true volunteer, then you're not, that's a workers' compensation definition. You have to look into that. And each area of those 10 different policies that you're talking about has its own requirements and strictures about what qualifies, what doesn't. So you just need to disclose that up front to your agent and let them help you work through that, because I know in certain policies you can go very thin, pay very little premium, but your coverage is very precluded. And I definitely defer to Mickey on all of those things. But you just need to kind of be aware when you're purchasing your coverage. But in terms of broader liability, if you have a volunteer who carelessly hurts one of your patients, then you could be liable for that. Because even though they're a volunteer, they're still an agent working at your fingertips. So you have to just be very careful and again, make sure or make sure that your provider knows.
Good answer.
Been burned a time or two.
Our questions. Going once, going twice. Sandy had a question. She wanted to know if anybody on here has confidential papers in their garage.
That's good.
It's a fair question.
I would say Tanya Triplett does, if anybody on this panel does.
Oh Lord. Just trying to lighten the mood a minute.
I'm storing some for Mickey.
Anybody got any more questions?
I didn't have a question. I had a story to share, but actually it might be a question. I'm having some work done on my property, and a lot of the we'll call them contractors around this area will just do a deal on a handshake and a verbal agreement. The amount of money that I was spending, I wasn't comfortable doing that, so I drew up a statement of work. It's actually what I do. Part of my day job is writing statements of works and contracts. So just wanted to share that, always kind of protect yourself, outline exactly what the work is to be done and what the acceptance criteria is, and when, you're going to pay and who's responsible for what. So I guess a question to John is, what is a statement of work as good as a contract? Is that considered the one and the same? Or is there more, documentation that would need to be done around that?
Yeah, in a previous life, I did some criminal defense work, and I will tell you that the Virginia State Contractors Board is they have been known to be pretty aggressive. And so if you have a contractor that comes to your property to do work, one, they have to be licensed for the level of contracting. And I used to know that by heart, but I can't remember what that is. Maybe Mr. Socia knows, but the work has to be within that level of their licensure. They have to be licensed to do the work. And then as part of their ability to hold that license, they have to provide you with a written quote on the work that's being done. And the reason for that is that written quote serves as the general basis of a contract for the work you may procure. So I've had some work done here with contractors that I trust and I know are licensed, and they know me, and so I always say, where's your quote? Well, you know me, and a handshake is good with those folks. But I tell them, don't leave here and not give somebody else a quote, because they may burn you. And the thing that happens is failure to do that work without the proper quote and without the proper licensure is a misdemeanor. And as part of the remuneration, usually the courts will say to those contractors, surrender the money you just received. So, you're talking about what you want and what you need. You may be able to produce a written statement that generally memorializes what you want, and it may meet all the necessary elements for a contract for your protection. But if they're not doing that work as a contractor the way they're supposed to under the state licensing, there could be real problems. So, fortunately, we are a trusting community, and it doesn't have to come to that. But I know I represented a contractor who was he was a magician, could do wonderful things. And as always happens, it came down to a fee dispute. The work wasn't what the lady wanted. He'd let his contract license. She calls the state contracting board. They send out an investigator, and he's guilty of doing the work without a license because it's lapsed. And
froze on us, John.
I will say, until John can get back in Gremlin land, if you are doing work with a contractor or discussing with potential work, go to dpor.virginia.gov and you can look up anybody that has a contractor's license, not only to see if they're still up to date, but see if they have any grievances against them. That's a good way you can weed out folks.
But the other thing is, on the other hand, and Mike said this a while ago, but people have unrealistic expectations of work also. And so, you might write that contract to say this doesn't include this, and this, because once you write a contract with somebody, they think that amount of money that they're paying should just be carte blanche to get everything they want. So, that contract needs to show what it includes this, and this, and it needs to be very precise, which Mike was talking about in his engagement letter.
And Scott, that address is dpor.virginia.gov. That's where you go. If you're any kind of contractor or professional, have to get your license, but you can also do a license lookup, and you can do it by zip code or by, however you want to do it.
Any other questions?
Hey, Kathy, I was going to respond to John's question to Scott about the contractor's license. So a Class C, it's up to $10,000 with labor and materials included. And then your Class B goes from $10,000 to $120,000. And then your Class A is $120,000 to whatever you want to charge. So.
Yeah. Thank you. John said that he was going to have to log off his system shut down. Any other questions? Anybody? Any comments? Any need for help on anything? You should be into your writing your business plan now. And Daisy, just a brief question. I sent you a private message. You probably didn't see it, but could you let us know if we're all unclear as to whether you're competing as a startup or an expanding business.
And if you want to just send that privately or on an email and you don't want to say
well,
that.
We all had to declare that, Sandy, so we need to know. Yeah.
Okay. Can I tell you tomorrow?
Yeah.
I need to confer with my business partner.
Okay, tomorrow would be the deadline because everybody else had to declare on the first night. Okay.
Okay. I mean, okay. Yeah. Okay.
Okay. Thank you.
And I just want to
Anybody
remind
else?
everybody. I just want to remind everybody about next week. The next week's session will focus on credit and managing a business. Billy Roberts with Virginia Community Capital will talk about credit and why, as starting and growing a business, how important that is. And then Carl Noblick, Carl is over the SBA for Virginia. We'll be talking about managing your business. So come armed with questions, but also they'll be sharing a lot of info and your head will swell.
Okay, we got Mike and Mickey. Last call. Any other questions?
I have just one. I'm sorry. I have so many.
That's all right.
What about
That's what we're here for.
Well, I have a lot. What about property insurance? We talked about liability insurance, but I also be leasing a building.
Yeah.
And they have, of course, insurance on the building, but audiology equipment is very expensive. And so how can I, what's the best way to just kind of simplify all the different insurance, I guess, that I need? Like, is there one person that does liability and property, or am I just going to have to seek out separate places for that?
No, you can. Most agencies have companies that offer combinations of those coverages. We've got one company here that will write the property, the general liability, the professional liability, and the umbrella liability, if you feel a need for that, all on one policy.
Okay, so it's just a payment.
Yeah, the only other separate policy you would need is workers' comp if you have employees. So, but now that's pretty rare. In fact, you don't see that combination very often. But you can get packages of property and general liability. That's very, very common. And the cyber liability we were talking about can be included in that package also.
Thank you.
And Mickey, can she
Any other
bundle in her
questions?
malpractice in that? Did you say that?
I did. The first comment I made there was we have one company here that for most classes of malpractice, now not every class, but most classes of malpractice, they will combine that. It's listed, it's not included, but it's all on the same paper to make it more simple to deal with and to handle. Yeah.
Okay, last chance, last call. Okay. All right. Well, thank you all, Mickey, Mike, and John, who had to log off, who said that he loves this program. We love John for participating. Thank you all so much for spending your Tuesday night. I know you all have put in long work days, and we certainly appreciate everything you do to try to help us out.
And tonight's video will be up on our YouTube channel for the Washington County Challenge, or up on the Washington County Facebook page in a little while. So just give me time. Thanks, everybody. See you next week.
Thanks. It was fun.
Bye.
Bye-bye.